Well, it's that day. The Federal Reserve is meeting today. We unfortunately have an attorney running our economy instead of an economist. Unfortunately, Jerome Powell thinks the sun rises and sets with him. And these are poor decisions being made that will create problems within our banking industry for a couple of years. So we already know the Fed's going to raise 0.25% today. They're talking about cutting in the future. So this is like eating cake on a diet before you start your diet. I'm going to gorge one last time. It doesn't make fiscal sense. We're exacerbating a problem after 3 of the largest banking failures in our country's history. So how is this impacting both the banking industry and mortgage rates? You'd be surprised that this is helping mortgage rates, but let me get to the banking failures first. Hiking in a banking crisis is not a good thing. This is the problem. The Fed has caused these problems. So how the banking industry works is they take in short-term or long-term deposits from you, the depositors. They have to keep 10% of those deposits on hand. They can invest 90% of them. So most good banks invest them in long-term guaranteed rates of returns, treasury bonds, mortgage bonds, and corporate bonds. They get a higher rate of return than they pay you, the depositor. The reason why is longer term guaranteed money pays more than short-term money, except when you continue to raise interest rates and there's an inversion on the yield curve. What has happened is short-term interest rates are paying much more than long-term interest rates. So you can go get a 3-year treasury bond and get a 5% return right now instead of keeping your money in a checking account that pays you nothing. Makes a lot of sense. We've seen them as low as 5% on a 1-year bond. So that creates a run on the bank. They're pulling money on deposits. They have to pay out more than they're getting on their investments over here. And this exacerbates the problem. So 3 of the largest banking failures in the last 2 months, and they're going to raise the prime rate. It's unfortunate that they're making decisions, looking in the rearview mirror, looking at yearly averages instead of real-time data with the technology and the reporting that we have in 2023. But that's what we're faced against. You can see that banks are going to continue to fail. The regional banks are really struggling. 40% of lending is in regional banks. So the mortgage industry seems fairly liquid. Many other lending institutions are not. Bank loans are suffering. I have talked to a lot of builders that aren't able to borrow what they're typically at, and they're not building because of it when we have lack of inventory. So this just amplifies all these issues we have within our economy. The one good thing is bad economy typically means low interest rates. So I say this tongue in cheek, but as a mortgage lender, we're rooting for job loss, financial crises, wars, because bad economy means lower interest rates because they have to stimulate. So the good news in all of this, if you can see my screen, is mortgage bonds are rallying from a lot of this information. And we're seeing the lowest rates really consistently since April 4th. So the best rates in a month. I think this will continue to go up. I've continued go up, which means lower mortgage rates. I've continued to say May 10th, the Consumer Price Index report for April is the magic number. I'll stand by that. I think we'll get into this territory and have the lowest interest rates in the last year. So if we can run any numbers for you, let us know. If we can give you our 3 tools to help win, let us know. If we can do anything for you, let us know. 312-731-4939.